Hey guys, welcome back to our YouTube channel. This is George. I hope you guys had a productive weekend, and as well you've had an amazing start of the week. Today is Thursday, so I'm just here to do a video about finding your daily bias. I had initially done the same video, a similar video, and posted it, but people have been still requesting that we do the video, so I will just take you guys through the same quite quickly so that we have to get ourselves doing something else. So daily bias, it's basically having the knowledge, understanding how to know the direction of the market on a specific day, like based on the previous candles. You can be able to understand what you expect on the next few candles that are going to be printing. Yeah, remember, there is nothing that is an assurity in trading. We all just have perspectives and insights of what we expect to be in the market. Okay, so that's why I usually say there's no one who is wrong or right when it comes to the same. So we'll just hit the rock on it. So if you're new here, make sure to subscribe on my YouTube channel so that you don't miss out on any new upcoming videos. And if you're a returning subscriber, yeah, thank you. So make sure to also drop a comment and a like in case this video becomes beneficial to you. So we're gonna be doing this, of course, on the daily time frame. That's why it's called a daily bias. So you're going to be trying to understand how to ideally know what kind of a market you can be expecting on a specific day. So number one is we first have to understand candlestick interpretation, because ideally we are trying to understand what the candlesticks are trying to explain to us, because the candlesticks are the language of the market. So we're going to be using both the candlesticks and the wicks, because that is what we majorly are going to be trying to understand. So first, let me just draw an example of a bullish market. We're going to be using blue for bullish candles and black for bearish candles, so that we easily understand the same. So give me just a minute. So yeah, then I will do this. That's our bearish candle, and this is going to be our bullish candle as well. So we're just going to change the color to blue and increase the opacity so that it's fully blue, and the same as this, so blue. So we're going to be having bearish candles as black and our bullish candles as blue. So first, I'm going to be giving you instances, because it's going to look like it's a model and it's something you're going to be it's something you have seen somewhere. So I will just not mention it, and you guys will tell me in the comment section, or I'll mention it as the video concludes. So first of all, for us to understand candlestick interpretation, we just have to need logic. You just look at the kind of candle body you're having and the kind of wick you're having to just understand what price trying to tell you. For instance, if you're seeing it's a bullish candle, of course, but you're having a long upper wick, so it means there's a lot of bearish rejection. The candle had pushed all the way to this point, but the bears were able to push prices back down. If it's a bearish candle with the same, it just means there is still a lot of bearish rejection, so the bears might be kicking in to hold prices. If it's a completely bearish candlestick, the same thing. So yeah, it's just logic. You just use common sense. I think right here there's no rocket science. You're just looking at what is price telling me. If this candle is maybe an indecision candle, if you're seeing a body that is in between the upper and the lower wick, so it just means that there is a lot of indecision in the market. So either of them might be taking control of the market. And of course, some people say that if it happens at an extreme point in the market, it ideally would mean that you can be anticipating or expecting what reversals for this particular market. So that's just that's all you need to understand about candlestick interpretation. Then now we'll just get rolling to the candles. So the first thing we're going to be looking at, or the first model we're going to be looking at, I'm not sure if this video is going to be too long. I don't want it to be. The first model we're going to be looking at is the model we call the CRT model on the daily time frame. So it's basically liquidity sweeps. Is basically buy side and sell side liquidity sweeps, and Yeah, no rocket science. So on whatever the candle you're going to be trading, I'm going to be giving us 3 instances that you're going to be seeing this. So first is let's have the candle that we're actually going to be trading. So we'll just clone this so that it's easy. So this is the candle that we are possibly going to be trading. Now this is going to be our first model or our first example. So we're having this on the daily time frame, so it just means that this would be the previous day's high and then this would be the previous day's low. I think that is just easy. You just go on the daily time frame, mark your previous day high and mark your previous day low. Once you've marked your previous day high and previous day low, now you'll be expecting to see price take out the previous day high or the previous day low and close within the range. Okay, and then now we can take a trade to the opposite direction of whichever the range that was taken out. Okay, so for instance, we say let's say that price ideally decides to take out the low of this particular day, and that is what you see on your chart. Price has taken out the previous day's low. For instance, the price has taken out the previous day's low and it actually closed above. So of course that's where the candle starts from, and that's how the candle closed ideally. Let's say that is the next day candle. So this means the easiest way to interpret these is first you've seen price has taken out the previous day low, and all the lows and highs have liquidity. And basically I'll be talking about liquidity on my next video to explain to you what liquidity really is, and yeah, how to go about the same. So you see, if the previous day low has been taken out and price closes within the range that we're talking about is the range between the previous day high and the previous day low. And number two, the second condition that makes this even better is that this candle closes bullish. So it takes out our low, closes bullish, and we have a long lower wick, which denotes that there's a lot of bullish rejection and price is trying to stretch higher and higher. So now we would be expecting that the next candle, okay, that the next candle that is going to be printing is going to be a bullish candle. Ideally, that's what we would be expecting. Yeah, so we would be expecting that the next candle that price is going to be printing for us is going to be a bullish candle that of course will start from there where price closes and stretches up high. So your main target is not this candle, and the actual candle that you're trading is this candle. So first you have to be patient enough to see price print these two candles. So of course mostly this candle. So this one is just going to come on daily time frame, mark the high, mark the low, and then wait to see what happens to prices. Yeah, so this is the main candle, or this is the candle that you're going to be trading after price has already given us a confirmation that it has taken out the low and closed within the range. That's when now we can say that we're going to be taking a trade stretching higher to take out these previous days high. Of course I'm going to be showing you now how to go to the lower time frames to find an entry now on the lower time frames to get in into the market, because now you see this is just a skeleton. You just know where price is going. You don't know where price is going to be getting bullish orders from. So you have to go to the lower time frames to spot where price is going to be getting the bullish orders from for you to take the buys. I hope that sinks in. Yeah, so that's the first idea, that's the first thing that my idea that could happen with prices on this for this particular case. So the next thing that the next idea or the next anticipation, or the second anticipation, would be price could possibly as well just take out the high. Okay, the price takes out the high and price takes out the high and it closes bearish, and of course we do not expect it to stretch all the way lower for this one to work. So it takes out the high and it closes bearish. For this case we want it to close bearish. So once price takes out the high and it closes bearish, it ideally means that now price has taken a different direction. We have taken out the previous day high, closed within the range, and we're having a long upper wick, so which would denote that we're having a lot of bearish rejection. So we expect the next candle or the next few candles to be printing to the direction of prices that have not been taken up, where liquidity has not been grabbed, which would be this. Okay, so we'll be expecting to see this candle print lower to check out the previous day's low. Price will always take out a high and also take out a low where there is liquidity. It doesn't necessarily mean that it must take out the previous day's low. Once price takes out the previous day high, we expect it to take out the previous day low, but it's based on the kind of momentum and liquidity you have in the market. Okay, yeah, this can happen, and then the next thing you're seeing is the next candle pushing higher. We don't know that. Okay, yeah, that can happen. So you have to ultimately see that all these conditions check in before you get into the market. Don't just rush. Okay, so those are the two instances when you're having a bullish candlestick on the daily time frame. It's just the similar. It's just a similar case when you're having a bearish candlestick. We'll just show you all the examples as well. Let's say that is our previous day candle, so we are just gonna mark the previous day's high, which is going to be there, and then we're going to be having our previous day low, of course, which is going to be there. That is our previous day's low. So now you're having your buy side and sell side liquidity, because these are basically buy side and sell side liquidity. That is just liquidity resting above the market and liquidity resting below the market. There's no rocket science. You guys know that. It's basically buy side and sell side liquidity. So we have our buy side liquidity resting here and our sell side liquidity resting here. The two instances are just similar. We can't be expecting to see price take out the buy side liquidity, and then we expect it to take out the sell side liquidity as well later on. So the first idea is we can be seeing prices take out that buy side liquidity, as you've seen there. Price takes out that buy side liquidity, and then this candle closes bearish, of course, and we have a long upper wick, which denotes what? Which denotes that we are having a lot of bearish rejection. So that is the first instance. So ideally, the next thing we would be expecting is to see our candle that is going to be printing next a bearish candle that is going to be pushing prices to the previous day's low. That's just it. Those are the three candles you can be expecting to see. Yeah. Oh, no, guys, this is crazy, man. This is crazy. This is crazy. This is wrong. You guys know that. The reason why this is wrong, this is a bearish candle. Yeah. So it would mean that this is our open and this is our close, which would mean that this candle has to open from here. You guys shouldn't. You guys so you guys are not even keen enough to see that I've lied to you guys. So ideally that can happen, but it happens on very rare instances. So it would mean that now our next candle is going to just be pushing prices to take out the sell side liquidity. That is just as simple as that. That can happen, but it's rare. It's very rare. But in the event that this happens, it actually means that we're going to be having a lot of impulse for this candle. It's going to take out the previous day low quite impulsively. You see? Yeah. That can happen, but rarely. I hope that is understood. Yeah, so that the instant I had drawn here was not making sense because of close and open. Because if these are bearish candle, this is the open, this is the close, and the next candle opens where we had a previous candle closure. So this is where our next candle would open, and if it opens here, it would mean that now this candle would be stretching higher, which would mean that this candle is going to be a bullish candle. Are we okay, guys? Are you guys understood it? Yeah, so which would mean that this candle will stretch lower. Okay, that's the first instance. The second instance, of course, which is now more common when you're having a bearish candlestick on the daily time frame, this one is more common. The next instance is more common, which is now price taking out the low. Because now it's easier. Price taking out the low is a lot more easier because we are closing our close is just close to our sell side liquidity. I'm at the previous day low. Okay, our close is close to our previous day low. So ideally we would be expecting to see this candle. We don't expect it to be as bearish, but this I'm just trying to give you all the possible instances. This candle can be a bearish candle. You see this candle, it can be a bearish candle. But when it's a bearish candle, it ideally means that you see it has broken one of our major confluences, that it has to flip bullish. You know, this candle should be the opposite of this one, so that we see that the opposite market is kicking in. Okay, so now once, if this candle is bearish but still closed inside and we're having a long upper lower wick, sorry, we just go to the lower time frames to find confirmations. But you know, there are different trades that you take. You have high probability setups, you have low probability setup, medium probability setups. So of course this would be a possible medium probability setup, because this candle has not flipped bullish. Because if it flips bullish, then it means the buyers are gaining enough control to push prices higher. Okay, yeah, those are the two easy instances. So it will mean that now the next candle that you're going to be having, this is a bullish candle, by the way. Let me just change the color so that you don't get confused. So it would mean that ideally the next candle that we would be expecting to see print is going to be a bullish candle that is going to take us, or to take prices to the to the previous day high. Are you guys getting that? So it's really not rocket science as well. Yeah, so those are the first easy instances. Now the second instance is where now you have internal range liquidity that is resting within the specific market. You see, like there are fair value gaps and there are imbalances, the volume imbalances that have to be filled before price continues in the direction of the market. Okay, so ideally when you see, for instance, we have let's say we have another candle that is let's use this first instance here. You have another candle that was, yeah, sorry, no, it's not. I want the whole candle plus the wick. Is it too much to ask? I need to learn that. Let me just clean this one. Clone, so that we have our, this is our bearish candlestick. So if you're having this as our bearish candlestick, you see, now there are other factors that can let price, or that can help us stretch prices lower. Okay, so first is if we have a fair value gap or an imbalance, let's say for instance resting below where market is headed. You see, because this can be possibly be what a market is looking like. So if we're having a market like this, so first you see in this case you have a fair value gap that is resting below the market right here. This is a fair value gap, right? So if you're having a fair value gap that is resting below the market, internal range liquidity most at times holds prices a lot more. Yeah, you have to be careful when you're trading and you're seeing internal range liquidity. That is fair value gaps. And even at times, you see this candle might not even print the way you expect it to print because there is this fair value gap. Okay, so this candle might take out that high and close even the way you expect it to be, but then this fair value gap is holding more more orders than what is than the orders that are resting at the sell side liquidity. So what would happen is price would take the orders from this fair value gap, stretch higher first. So this candle might start from there, a close bullish, and then later on now we can see that prices take out this candle low. I don't know. Last week, I think there was an instance last week. Was it on the daily time frame? I'm not sure. Let me just confirm that. Was it on USDJPY really? Okay. Give me a minute. Yeah, this was on USDJPY, the weekly time frame. So you see what had happened here is I want to use You see what had happened here is, you see prices for this case, price had taken out the previous day's low for this case. So ideally we were expecting to see price stretch higher to take out the previous day's high, right? There's no rocket science there. So after ideally it played out the same exact way I've just shown you on our second or third example. Yeah, price takes out the previous day's low, closes above it, and then the next candle, the next few candles will be targeting the previous day's high, and that's exactly what happened for this particular case. And you can see even here, price took out the previous day's low, and once we took out the previous day's low, we were expecting the price to take out the previous day high, and that's exactly what happened for this particular case. So there is really no rocket science, yeah. Yeah, even as well you can see, but then you see where prices were stretching to, it's giving you very nice both conferences. Price is stretching towards a fair value gap. You see, this fair value gap helps you be sure that price is stretching lower, and now these candles that we are seeing here are going to be pushing her to check out this previous week's high, because of what? Because of the kind of orders that we've picked from this imbalance, from the fair value gap. Okay, I think there was also an instance on USD card. Was it USD card? I'm not sure, let me just check. USD card, was it a USD card on GPY? Yeah, it was on GPY, the instance I really wanted. So first is, let me delete everything. So first on JPY, most people at this point would have taken the orders, would have taken buys, yeah, because now you see what has happened here. You have taken, price has taken out the previous day high. For this case, you see price has taken out the previous day high, so ideally you're expecting to see price stretch lower to take out the previous day's low, sorry, the previous week's low, sorry, we're on the weekly time frame. Yeah, by the way, you can use this on the daily, weekly, or monthly time frame. So once price has taken out the previous week's high, we expect you to see price stretch low, take out the previous week's low. Yeah, I know most of you would be expecting the same, but looking at the kind of momentum that we're having around here, is price is stretching higher and higher and higher, and there's nothing that I'm not seeing anything that would make prices start stretching lower, because we do not have an order block here, we don't have an imbalance here that has to be filled before price continues lower. So now this next week, myself and a few more people, for those who usually attend my TikTok live streams, we expected to see buys from this fair value gap first. We actually did not expect to see price stretch lower to take out this low. No, we were expecting to see prices take out or pick orders from this fair value gap to stretch higher. You see, that was and that's exactly what happened. And the actual reason is, I've told you, internal range liquidity holds more orders. Like orders that are in balances hold there are a lot more orders on imbalances than what is going to be here, because anytime market gets to a point where there is saturation of orders, I'm aware there is an order block, or be it a fair value gap, be it a supply, a demand, a support, a resistance, price has to react from that point, because there are orders that are resting there, unless the orders are not able to hold prices. But as long as they are able to hold prices, we're going to be seeing price react from the same. So first we had to see this week be a bullish one. This week that we're having, it had to be a bullish one, because we are taking out the previous days, or we are taking out an imbalance that had been left by prices. And then now from here, then we can see price going to do whatever it wants to do. Okay, so from here now we can be expecting to see prices stretch lower to take out this previous week's low, because you see it's still unfinished business, because we had grabbed out buy side liquidity. We expect to see price grab out sell side liquidity. You get? So first priority, of course, in as much as you're trading this model, is imbalances. Imbalances should be very, very important. I'm going to do a video about imbalances, the fair value gaps, volume imbalances, and all the other imbalances, and so that I explain to you which ones hold more orders. Okay, so we'll go back to USD. So basically, I've even shown you examples. I was supposed to show you several examples. I think I've even shown you examples. Yeah, you can see even on USD. Let me just show you a few more instances, and then now we can. So I didn't want this video to be as long, but it has. So you see that is the previous week's high that has been taken out, and you can see we're having a long upper week. For this case, we mostly do not you mostly do not care about this bearish candle, but at sometimes you just use logic and see, is it really making sense? Because now here we don't have any unfinished businesses, because you see this the imbalance that was probably here, price had already filled the imbalance, so we do not have anything unfinished below here. So we just get prices to take our set liquidity for this particular case, because we're having this candle stretching lower. And you can see even here, price had taken out the previous week's high, and it is the previous week's low, and now we took out the previous week's high. The same happened here. So you see price has taken out the previous week's high. Now we're expecting to see price stretch out to take out the previous week's low. So what this happens, or what this helps you with, is to just get the directional bias, the direction that you're expecting to see market head to. Okay, so by this time you do not know how to enter, by this time you do not know how to execute. Yeah, you are not sure how to place that buy or sell, because now you have to go to the lower time frames to find an entry, which I will do a video on the same to just show you guys how to do that. Okay, yeah, basically that's on the weekly time frame, and I've told you can do the same thing on the daily time frame. It's just as easy as that. You just go on the daily time frame, wait for prices to take out the previous day high, close within the range, and then now you can take orders. But you can see there are days like these. You can see there are days like this where price takes out the previous day low impulsively. I'll also be showing you now how to expect, or what do you now expect to see in the market once you see such a candle that takes out the previous low, previous day low, maybe impulsively, and you're not seeing any prospects of prices taking out the previous day high and stuff like that. So we're going to be looking at that, because now there are other factors that we have to consider, yeah, for us to understand such kind of a market. Yeah, I don't want this video to be too long. It's already about 25 minutes long, so I will just leave from there, and I will be dropping the next few videos as well. So I promise 3 videos: liquidity, imbalances, as well as now how to scale down to the lower time frames to find your entries on this. Once you already have the daily, what the daily bias or the weekly bias, or what you're expecting over the next few candles or candle. Yeah, so we will stop it from there. If you got to this point, you can just drop a comment and confirm if you learned anything. And yeah, make sure to subscribe to our YouTube channel and like this video, drop a comment for more educative content. I'll see you on the next video. Bingo. And remember, you're just one trade away from all the success you need from trading.